Thank you. Thank you.
Let's put this round here.
All right.
Yeah, that's perfect.
All right.
There's your mouse. And if you need the thing to draw with, just let me know.
Okay. You hear me all right?
Yeah, is that good?
Okay. Well, first of all, it's a pleasure to be here. This is a great venue, a great program you put together. It's fascinating to see your software and how it links to Wyckoff. I think Wyckoff would be very proud and pleased to see it. Yeah. And just a word to the folks in Malaysia. Thank you for coming by. I hope some of the friends that I tutored are in there also from Malaysia, from Kuala Lumpur area. Anyway, just a little bit of a background. I come from the world of academia. I was an English professor. I never knew what going long and going short meant. Certainly going short was something I couldn't understand. All right. You hear me now?
Yeah, that's it.
I started off working in the research department of a commodity brokerage house in Memphis, Tennessee, my home. My job was to make handmade charts all day on chart paper, even stochastics and RSIs by hand, which was a lot of fun. And these tiny little grids to draw lines, I never thought I'd be able to do it, but I became very much enthralled with it, just the tactile approach to the market. That's where I learned my first lesson about trading. Sell when when the price goes off the chart to the upside, and buy when it goes below the graph on the downside. It was great advice. Anyway, I was fortunate enough to become a technical analyst, and at the same time we were brokers. I met a gentleman who introduced me to the Wyckoff material. In 1971, no one was shouting the name of Richard Wyckoff. In fact, the name Richard Wyckoff was a secret. It was whispered about. No one wanted the rest of the world to know about it. It was considered the secret of the universe, even though Eliot used that term for one of his books. That's Ralph Newton Eliot. Nature's Law, the secret of the universe. This was the secret of the universe, and nobody wanted to share it with anyone. Well, someone was kind enough to share it with me, even pay for the course. And all of a sudden I became not just a mediocre analyst who would get on the hotline at Conti Commodities in the morning and would say, the moving average is pointed up, the momentum indicator is slightly overbought, and the last thing I wanted to know, someone interrupted and said, well, tell me, would you buy it or sell it? Which is the last thing I was interested in that I could do. But after I'd taken the Wyckoff course, it was a world of difference. I knew where to buy and I knew where to sell. Of course, it took a while. As you've already heard, Wyckoff came to Wall Street in 1888 at the age of 15. Oh, I forgot something. Gary, would you hand me that little notebook I have on my desk? There's a little piece of paper right on the inside. That inside there.
If you speak up just a little, because the internet people say
All right.
It's a little bit...
Well, my voice isn't as loud as it used to be. This is something that in Wyckoff's autobiography that he wrote about himself. Each chapter is a year in his life. He wrote, I had now spent the greater part of 17 years in Wall Street. As a boy, clerk, a silent partner, and managing partner in the stock exchange houses. But with all I had seen, studied, and observed, I had yet no well-defined plan or method for money-making in the stock market, either for myself or my clients. That was after 17 years. So if you're just starting to feel encouraged, it's never too late. Anyway, by 2 or 3 years later, he understood the game completely. And what turned him around was the study of the tape. He met a man who had been a floor trader at the stock exchange, and they started studying the tape together. Wyckoff was writing a little publication called The Ticker, and as he was learning about tape reading, he was writing articles on it. And these became the nucleus for his first book, published in 1909, Studies in Tape Reading, under the name of Rollo Tape. Then later, late in life, he wanted to start a University of Wall Street to teach the public how the game is played, how to make money. But he was too ill, so he wrote this course. There's two parts to the course, one that deals with stock charts and daily charts, and another that deals with tape reading. Both of them are very, very useful. I use this material all the time. Now, Wyckoff did use the terms accumulation and distribution, but he didn't talk about patterns of distribution or accumulation. For those of you who know about Wyckoff and the Wyckoff so-called paradigm of accumulation, where a market comes down and finds temporary support called preliminary supply, and then you have a selling climax, and then you have, that would be preliminary support, then a selling climax, automatic rally, secondary test, and so on. He never constructed that. That was done later by other owners of the course. But it was drawn from much of his writings. It just had never been formalized into that. I use a lot of the original Wyckoff stuff. I don't really talk much about accumulation and distribution as much as Gary Fullett does. But I'm sure he'll introduce you to it tomorrow. I had, in the last few years, I guess about 7 or 8 years ago, I came up with this model that I've always had in my head, and it's on the first page here. It's on the screen right now. Markets, as you've already been told, markets spend most of their time in trading ranges. It doesn't matter if that trading range encompasses months, minutes, years, whatever. The same behavior is going on. And where do you find the trades in a trading range? Are they in the middle? Are they on the edges? Whereabouts? I always compare it to fishing. I grew up in the South where we fished in freshwater lakes, and we never fished in the middle. We always fished around the edges, around the sunken logs and the drop-offs and in the little coves. But the person who fished out in the middle was mostly interested in laying back and drinking beer, as far as I could see. Anyway, we worked hard along the edges of the lake, and that's where we caught fish. That's where the trades are, around the edges of the lake. And I've circled them on this diagram. One is the upthrust. The market comes to the top of a trading range, and it tries to break out, and it fails. Number two is a spring. The market goes underneath the bottom of a trading range, attempts to break down, and it fails to break down, and the market recovers. Those are the two best places, the two best trading opportunities that you can get. As I've said over and over again, wherever I've spoken, from Cyprus to Hong Kong, you can make a living trading springs and upthrusts. I say it again. That's all you need to do to make money in the market. You don't need to understand anything else but how to recognize springs and upthrusts. Well, unfortunately, you don't just do that by drawing a horizontal line and saying if the market goes under this, therefore it's a spring. It's not quite that simple. As has already been mentioned, if a market goes underneath a line of support in a downtrend, it likely will continue to go down. So springs fail in downtrends. Upthrusts fail in uptrends. You might get a little money out of them, but not much. The money is to be with the trend. In addition to those two places is a breakout. After a breakout, as you've already heard.
Just take that off. They can't hear you clearly on the internet, so I'm going to try something. So just let them. Excuse me a sec, everyone. You move your foot. What I was going to try and do, see if we can bring that speaker. If you do that over here, Rob. Hi everybody, I know some of you said that you can't quite hear clearly over the internet, so I'm going to try something just to make sure you can hear this. So I've just had to interrupt David briefly here. All we're going to try and do is put the speaker up close to the headset here and see if we can somehow fix it. I'm not quite sure how we're going to do this, but we'll try. So let me know what this is like. thing, actually. I've got an idea. Can we see if we can put these on your ears like that? If that's
Sure.
okay, you should still
Right
be able to
ahead.
hear it, and then because then that'll be right by.
Yeah.
So let's try. You should still be able to hear.
Yeah.
And put that up. Now, just do a sound check to everybody. Can you say? Hey, just do testing 1, 2, 3.
Testing 1, 2, 3. Can you hear me?
Is that better, everyone? That should be better.
Not in here, but on the internet.
It's just the static in the background. Okay, yeah, I think that's a lot better. Let me just switch the mic off one more time. Sorry to interrupt you, but we've got to get this right.
All right.
Okay, there you go.
Okay. Where was I? All right. In addition to springs and upthrusts, other places to trade the market, very good low-risk places, are backups to test a breakout, which seems to be very central to what we've seen with volume spread analysis with the trade guider software, or to test breakdowns after a market has not sprung but broken down. Later it will come back and test that. Not always. One more thing about springs and upthrusts. All right. The beauty about trading springs and upthrusts is you are trading at the danger point, at the risk point. You're going long after a breakdown underneath support where your risk is very well defined. You are quickly proven right or wrong. And you don't have to go risk as much as you would if you go long in the middle. When you go long in the middle of the trading range, you have a lot more risk and a lot more uncertainty. Conversely, to go short on an upthrust, when you see evidence that the breakout is not going to work, you're going short at the danger point where the risk is least. That's the beauty of the two strategies. Okay, let's go to the next chart. What I'm always doing when I look at a chart for the first time, I draw trading ranges. I frame the bottom and the top of every trading range on the chart. I have them marked here as TR1, TR2, and so on throughout this next chart. It's a NASDAQ daily continuation chart. I'm interested to see if there are going to be any springs or any upthrusts or any absorption or any tests of breakouts or tests of breakdown. And I've marked them here. I've drawn a little red circle on the screen. I guess it's not red on your sheet, but you can see where I've circled the different types of behavior. This is what I do all day long. I sit before my computer with a 5-minute chart and an hourly chart and a daily chart. I have the hourly and the daily just so I understand where I am. And from the 5-minute chart, I make trades. I look for springs, upthrusts, absorption, tests of breakout, tests of breakdown. They repeat themselves over and over and over again. And I'm wrong, too. It happens a lot, but I'm not risking much money to find out. And I'm trying to trade with the trend, always with the trend. I'm not doing any trading against the trend to make a quickie. I'd rather just stay with the trend. All right. Here's another example. No, this is a different chart, yeah. Here's a chart that's unnamed. There's no price scale, and there's no time scale. All we have here is a bar chart. No volume, high, low, and close. There's not even an opening on these bars. Now, how many springs do you see on this chart? Can anyone tell me how many springs are on this chart? I see someone raised his hand with 2 fingers. 2 is right. Where are they? What? Yeah. Right here? And then right here. That's right. Now, What would be nice would be to draw the lines. The lines will bring the story out. Do we see an upthrust on this chart? Someone else. Where the market goes above a very well-defined high and turns down. Yes, sir. Right there. Correct. All right. Let me just show you that anybody can recognize a test of a breakout. A test of a breakout. Well, let's say a test of a breakout. Right here. The market jumped above this high on this bar, and right here we backed up to it to test that breakout. I'll show you the chart with my lines on it, and then I'll tell you what this is. If I can draw this, if I can do this. Okay, here they are. I've drawn a channel or two and the horizontal lines. This chart is a yearly bar chart. It's cash cocoa prices going back to 1931. And it's plotted through about 2005 or 6. I haven't updated it in a while. It's on a semi-log scale. What was bullish about this spring right here? Even without volume, you can tell what's bullish about this spring right here. Anything stand out to anyone? What stands out to me is the narrowness of the range. That's a whole year in that little range. What does that say about ease of movement down? Is there any ease of movement? None whatsoever. What does that mean when there's no ease of movement? Somebody is buying, and they're not letting it go down. Maybe they're accumulating, but all we can see on this chart is one bar. But here's one whole year in that little narrow range. Most frustrating for someone who was bullish like I was. I remember it well. Let's see. Notice that I drew two channels. The big channel, the market went up above it, became overbought. We turned down. I had a steeper channel, so we have sort of a confluence of lines. I like to do that. I like to get as many lines together that come to one point as possible. I also have two axis lines drawn on this chart. Wyckoff didn't talk about axis lines. It's something that I've noticed, and somebody who helped teach me, the man who helped pay for the course and introduced me to it, showed me years ago. There are places on charts many times where the line served as both resistance and support over a period of days, weeks, or in this case, decades. You see right here we have a high. Right here we have an upthrust. Right here we have resistance. Down here we have support. And then down here we have a spring of that line. Conversely, we have another support line a little higher. It traverses much of the price movement. It's support there, it's resistance in here, and then it's support right here. The things that I'm looking for on charts, I look at the size of the range and the position of the close. I look at the volume. I'm interested in the interaction with the lines. Another important thing is markets have a tendency to test vertical and or high volume areas on a chart at some point. For example, right here we have a breakout right after World War II. You can see World War II in these little dots because there was a freeze on prices. Trading stopped, and cash prices were locked at a certain price. But right here after the war, the market takes off with great ease of upward movement. Notice that we come back to test this area. You see? This happens a great deal. Over here was another breakout, right here. Big wide range as we moved above this trading range. We tested it here and here, but we stayed within the range of that bar, of that year. I'm interested in follow-through or lack of follow-through. In other words, obviously with this little tiny bar down here where we had the spring, there was no follow-through after that on the downside. Or on a daily chart, I look for that. When a market breaks down and doesn't follow through, I become very interested, and especially if it breaks down under support. When I was younger, I used to box some, and one of the things I knew is if I was in a ring with a guy and I knocked him out of the ring into the 5th row of seats, which didn't happen, by the way, but if I did, he was not supposed to get back up in the ring and start slugging on me. I mean, this is like tugging on Superman's cape, if you remember. In other words, that's what happens with a spring. It breaks down, it gets knocked out of the ring, and all of a sudden, lo and behold, it's back in the ring. Why? Why didn't it follow through if the sellers were in charge? Anyway, I'm interested in follow-through or lack of follow-through, ease of movement or no ease of movement, depicted by range. And the next two charts show examples of some of the things that we've already talked about. This chart, I drew a little box around the absorption areas. I don't remember if there's a good chart of absorption or not. It was discussed by Gary Dayton. Here's some of the things that you can expect to see when a market is in an absorption area. First of all, why does a market meet resistance at the top of a trading range? Gary said a great deal about this already. But number one, the people who bought that high, where there is resistance now, and held on through the break, now get an opportunity to get their money back. And they've had enough. They rode the market down, and now it's coming back up, and they're even, so they're liquidating. Then the new longs who were smart enough to buy the correction after the last high are taking profits against the previous high. Only natural. And then the rest of the supply is coming from new shorts. New shorts who say, well, we topped at this level once before. Why can't we top here again? I'm going short. Right? So the market, in order to go higher, has got to absorb through that supply. Supply created by long liquidation, long profit taking, and new short selling. And that is a process sometimes, and it's called absorption. Wyckoff used that term, absorption. Now, how do you know when absorption is good? How do you know how it's going to, what the outcome is going to be? That's the key. We go into this tight period of lateral movement. You look on Gary Dayton's chart, where we have this absorption area, it's 13 days of lateral movement. His 13 days didn't take out the high of the resistance line. Sometimes absorption will. How do we know? One way is there are threatening bars within an absorption period. Days that turn down and have an ugly close and seem to portend further weakness. If there's no follow-through, if the threat disappears, why? No more selling. It didn't attract the following of selling. Another thing is we have a tendency sometimes to have rising supports within an absorption area. Sometimes in an absorption area, we'll have a spring where the market will break underneath the bottom of the little absorption area and then not follow through. So all of these kind of things are clues. And lastly, one of the things you see often, not always, but often, at the right-hand side of an absorption area is that prices begin to stick. That is, they stick towards the upper end of that little trading area against the resistance line. They're pressing. All of a sudden, they're not letting go. They're not backing off. There's a tendency for prices to close near the upper end of each range, of each bar. All right, let's go on. There's another one here, just like this chart, that follows next. This is Federated Department Stores. I don't usually use a moving average, but on this chart I did just for someone I was teaching at the time. But you notice how many springs there are as the market was going higher. You see how I framed the trading ranges. Down here we have trading range A, support line A, resistance line B. You see we have a spring of line A. Then we have a smaller trading range right in here and another tiny spring. And here's a breakout, right? And then this is a test of a breakout. Now this is a little spring here and it's also a test of a breakout, and so on. But when the market's going down, you see how I wrote here, failed spring, failed spring. There are lots of little springs that look enticing to buy, but they don't materialize. So the trend is the thing. All right, here's a 5-minute chart of the S&P E-mini. Is this a spring? Can I draw a line across these lows and call what we have here a spring? How many people think this is a potential spring? I see one. Anybody else? No one else in here thinks it's a potential spring. Someone says it's a downturn. The market went underneath the line of support that's not drawn here. It closed under the support. We had widening price range, and we had very heavy volume. That looks like it could be the beginning of a spring if there's no follow-through. But what did we do on the next bar? Did we get away from the danger point? Do we think this thing is really going to go up? No. Look at the next chart. This is where we were, right here. You see, the market held for a bar or two, and then it breaks again with even heavier volume right here. You see that? Now, we could draw another line of support right here, across this last low. Is this last breakdown, is this a spring, or is this a false spring and a downtrend? Who thinks it's a spring? Boy, nobody thinks it's a spring. Is there a change in behavior on this bar as opposed to this bar right here when we broke down? What's the difference between this bar and this breakdown bar over here? There is a difference. Can anybody tell me what it is? Yeah, it closes above that horizontal line, doesn't it? In addition, it closes well off the low of this bar. So what do we know happened on this bar? Someone's buying. If someone's buying when the market breaks down underneath the line of support, then we have a potential spring. It's all simple logic. There's no voodoo here. We're not talking about tunnels in the sky. Anyone know what discipline uses tunnels in the sky? Yeah. I'm not knocking Gann. Wyckoff thought Gann was tremendous. All right, here's the next chart. It shows all of the lines. What did I do here? Okay, you see how I drew the horizontal lines that we broke through? Notice also, measuring from low to low to low, We have a low here and a further low here, and then here, but right here we don't make as much downward progress. That's also called shortening of the thrust. The way you look at this is you say that within this decline, the thrust is shortened. Within this trading range down here, we've had a spring. You follow me? Notice I draw over here another spring. Notice on this spring, the market closed just about on the low, in new low ground. It looked like death. It's supposed to be death. It's supposed to keep going down. But it doesn't. Why? Look how it rallies. Look at the ease of movement on the next day. You see? This is the best bar we have on the upside. Well, we don't have much history, but that's the biggest range on that at that time. Okay. Any questions about any of this that I've mentioned so far? No, I knew I'd do that.
Dave, there is a question, actually.
I have a question. How do I move this thing up?
You're using this thing here. You just move it backwards. You just move it like that.
Oh,
with the wheel, and you use the wheel to go down.
Oh, now I can do that.
That's
man,
easy,
I can do that.
Question for you while you're
All
here.
right.
When you see those downward movements at the bottom there, do
Yes.
you buy that, or do you wait for the reaction and then maybe some sort of lower volume bar back into that area to confirm the thrust?
If the market closes above the low and well off the low of that bar, if we close, like on this last chart,
Yep.
if we close above the horizontal line that we broke and well off the low of that bar, I don't wait for a secondary test.
Okay, that's great. Nor would Tom Williams, just so you know.
I mean, this is a fast world. They're not going to linger around here and let me politely get aboard. All right, let's see if I can do this. Well, I know how to do it. I learned already. Okay, here's another little question. Did I skip anything in my presentation? I don't think so. All right, look at this chart. This is a day. Damn.
There you go. Don't know what happened there. Oh, it's.
Well, I told you I wasn't good with machinery. Keep going.
Okay, so
Right
let's get you
down.
to number 10, which is where you were at, which is that one.
Right there,
correct?
right there. Thank you.
Okay, and let's just leave that.
Just a little bit up.
Okay.
The question is, looking, and you all have this chart in your book. Okay. Is this, you see the market goes underneath the level of support. The question is, and then it turns up. Look at all the big volume we had when we went under the low. Is this spring, and I have the question there, will this spring continue or not? Anybody want to venture an opinion? Yes. Give that man a cigar. He said it right. He said that he sees the closes after that are all on the high. That's right. In addition, notice that the last 3 days going down to the bottom, right there, we have tremendous ease of movement. This is a $7 break, and I think $4 of it occurred in the last 3 days. So this is a slam to the mat. This is that demoralizing, wide-open, high-volume break that we know as a selling climax. But in this case, the market reverses immediately. And if you draw the channel coming down from the high, we'll just go to the next chart. I want to see how easily you do this. All right. Yeah,
We'll make a good team.
You're good.
We'll trade together one day. That's it.
All right, so you see the channel. We come down and we get to the bottom of the channel, which I think represents an oversold condition, and I think it represents it better than an RSI. I spent a year of my life playing with RSI before I knew better. Anyway.
I never had that misfortune myself.
Anyway, so we came to the bottom of the down channel, We had climactic or stopping volume. And now, as was pointed out, when the market turns up, notice that there's not a great deal of volume on the rally. But what stands out on the rally is that all of the bars are closing on the high. Every time it tries to go down intraday, it bobs back up to close on the high. What does that tell you? What does logic tell you? That market is buoyant. Why is it buoyant? Because there's demand. Again, this is not brain surgery here, folks. This is simple logic. And then on the last bar, you see we do close lower. In fact, we gap lower. But regardless, we don't have any sharp increase in volume, and the market again closes on the high of that trading range of that day, of that bar's range, not the true range. Okay, let's go on. I appreciate all this help.
Pleasure.
It's just hard for me to do more than one thing at a time.
Yeah, I know the feeling. I do that every day when I'm trading. There we go.
Okay, this is a study of a chart unfolding one bar at a time. Now, we're not going to do too many bars here. Can you get it up just a little bit further? I want to see how really, yeah, that's good.
There you go.
All right, in this trading range, what do we see? Before you see the last bar on this chart, could you have had any indication of which way the market was going to go by just looking at the price and the volume? Which way do the market move easier? Does it move easier higher or lower? Right. The wide ranges are mostly on the downside. Where does the heavy volume come in? Again, mostly on the downside. Also, we even have, let me just take this a moment. We have a bit of an apex forming. You can draw a line from here and a line down, and you see that we're coiling, we're tightening up. I love to see price tightening. That tells you something's about to happen. On your charts on your desk, perhaps you can see that on the next to last bar, a tiny bar, the market tries to go higher. It takes out the high of 2 days to the left and falls back to close closer to the low than the high. That's a little minor upthrust. It couldn't go after it took out that little tiny high. Yeah, very good. Okay, let's go to the next chart. You're doing a lot more things here than just moving it down.
Yep, we're just erasing that.
Mm-hmm.
And we just scroll down to the next chart, like that.
Okay, now the things that I mentioned, many of them, are here on this chart. I've colored the lines. I do that by just simply drawing a trend line on top of that price bar and coloring it red and making it bolder than the other line. So you can see the ease of downward movement on most of those bars that are painted red. And you line it up, you can see the volume. And of course, on the last bar, we have great ease of downward movement, and we have very heavy volume. And when you see very heavy volume and great ease of downward movement as you approach a previous low line of support, the odds favor that you're going to make a new low. Let's go to the next chart. Okay. Now we have the next chart. You see the next bar. What is the distinguishing feature about the next bar? What is something that stands out when you examine this for the first time? What? Volume. Yeah, what happens here? We have volume that's greater than it was on the day before, and the range is probably 3/8 the size of the previous bar. What does that mean? Just logically, what does it mean?
Can I tell him?
You want to tell?
Yeah.
There was a lot of effort and result. You said it too.
Yeah,
In other words, there was a lot of effort to take the market down and very little progress and huge amount of volume. The volume reflects the effort. Yes, sir.
One thing I kind of
Okay. The question is, we're approaching a previous support line, and while we do have great volume, and we still close on the low, and wouldn't we expect some of the shorts who sold in the hole on the left side of the chart to want to cover now and maybe support the market? It's possible. And I think that your point is well taken about the position of the close. Since the position of the close is on the low, and we have such heavy volume, I don't think I'd want to be a pioneer here and stand in front of this. I would want to wait and see one more day, at least. I got to see something that talks to me better than this, but I do know what it means. And it alerts me to the potential that since there's buying down here, that we're going to have a turn on the upside. Does that answer your question? All right, look at the next bar.
Next slide.
Yeah, next slide. Very good. Okay. Now, we go down again. A very narrow range. The volume is even heavier than it was 2 bars prior. Can you imagine? The volume is heavier than it was 2 bars prior, and the range is even smaller than it was on the previous bar. Well, just on the bar itself, we do have shortening of the thrust. But this is unbelievable. Here we are pressing down. Now we've broken the low. We've had no ease of downward movement after breaking the low. We didn't attract a whole mob of new selling. It looks to me like we attracted a whole mob of what?
Buyers.
There you go. Buying. Buying. This is the place. Next bar. Now the market moves up. We have the widest bar in 3 days. We have the heaviest volume in 4 days. And the market closes closer to the high than the low. How many people would buy this market?
How many? Put your hands up. Raise your hands. How
You
many?
better. You better.
Come on. Here it is.
No, this is a great spot. This is a gimme. And they come along all the time. All right. Next bar. Okay. Now we have an inside day. That means it trades within the range of the previous day. The volume falls off precipitously.
Can anyone tell me what this looks like? I've shown you a chart today that this looks almost identical to. Can anyone remember? Yeah, but can you remember the chart I showed you where this actually happened and it was in the news a year ago? Think about the chart I showed you first thing this morning. It's been a long day. And there was a lot of ships waiting in harbour to come in. It's the crude oil. What David is showing you here is exactly what happened in the crude chart I showed you this morning. Exactly the same principle where we had red or green signals at the bottom. Green. Buy. Which is why Tom would be doing exactly the same here, piling in with the rest of them. In fact, if we remember, JP Morgan did not want their order put through until after hours. Why? Because they were all rushing in. If you can spot these. Now, the news will probably be bad here, won't it, David? They probably won't want to give you any clues.
That's right. All you hear on CNBC on this day is, APA looks sick. It can't rally away from the low. There's all this volume and the market doesn't lift off. Our technician says this. Our analyst with so-and-so company says don't touch it. We've got projections for $25 lower, and so on. Yep. If they give it any attention at all, because it's not bullish. They're just cheerleaders, remember that. Okay. Next one. That's all there is on that chart. We go straight up. Yeah. We go above the high of the chart by $25. I think we go to 80. And it doesn't take very long. Yep. Next chart. Okay, I think this is the last chart I have for the day. And I've added a little something else on this chart. You see we have price and I have volume, but I have underneath in colors the true range. I believe you can trade a bar chart without volume by just plotting true range. You can do it certainly with Forex, and I'll show you tomorrow. In other words, wherever you have wide range, it's almost always associated with large volume. You saw that on the chart of APA when we looked at it. And you can see the down ranges are in red, the up ranges are green, and if there's one that's unchanged, it's colored black. And you can look at this many times. The volume will not give you a clue, but the range will. Many times you have modest volume, and you'll have a huge range. You just didn't draw out any big volume that day. So let's bring it down a little bit. Yeah, bring it that way. I got to see the top of the chart. The question is the top of the chart.
That one?
The other one.
Oh, other one. He was just saying how good I was at this, wasn't he? I knew.
That's good.
How's that?
I'm glad he has a few problems.
I'm not perfect.
Anyway, this is an idea of an upthrust. The market goes above the high. Notice that when it goes above the high, that look at the position of the close. Now you don't know for certain. It didn't just fall apart. We had a very good size volume. We had a good size range. If you notice, the green range bar, I think, is the largest range in quite some time on that bar, and it is an up bar. Then the market breaks, and we come back up a few days later to test right there where he's put the red dot. And the volume is very low. Look at the position of the close, well off the high in the middle of the range, and the market is ready to start to move down. It gives a little ground, and we come back up one more time to test the upthrust. And after that, the market turns down. But this is a classic upthrust with a secondary test. You don't always get a secondary test after upthrust because they're faster. Tops are usually faster than bottoms. Any questions?
Yeah, I'd like to clarify something here as well. When we have two types of things in VSA at the top here. We have testing, which is where the body of the bar goes into the body of the bar behind it.
Mm-hmm.
But something that we also have that Tom talked about was something that's called genuine no demand.
Mm-hmm.
Now that will be where the bar starts to form behind the bar behind it after a serious sign of weakness.
Mm-hmm.
That has to be there. And it tries to go back up to the close or the high of this weak bar here.
Yeah.
But it doesn't. It's not called a test in Tom's VSA terms. He calls it no demand because the volume will be less than the previous two bars.
Yeah.
It will close on the high or middle, and the next bar will have to close down to confirm it. But it's the same thing, just in a slightly different
Different terminology.
Yeah, it's the same
I
thing.
mean, this is certainly no demand, and then you see immediately you have widespread as you come off that high.
Mm-hmm.
And you can see it with the red. You don't have that much volume when you come off the high, but you have a wide range because the true range bar down below picks it up. And this is not an average true range. This is just a one bar true range. In other words, per bar. And I'll show you tomorrow how I use this on Forex charts and so on. Well, I don't have any other charts for today.
Okay.
I have a question for you, David. Would you say that the first break with the wide ranges off of 54 adds to the story here?
Absolutely. I wanted to say that too. Thank you. The question was the wide open breaks on the left shoulder of that formation right there.
Mm-hmm.
The wide open break and the volume, is that something that's a precursor of things to come, bearish things to come? And they certainly are. I guess this is about the closest thing to Wyckoff's distribution as you'll ever see it. And, you know, he would probably call that preliminary supply. The way the market broke, you can see it's the largest correction, the deepest correction since we have the chart on the left, since it turned up on the left, and it has a lot of volume. And then we come up for a buying climax / upthrust, and then we have a secondary test on the right-hand side, or what Wyckoff would call last point of supply, before the market breaks down and goes into markdown. That would be the very far right.
Yeah.
I don't think about that too much, but I think you can hardly avoid seeing it here. Any other questions?
Craig?
Given that we're talking about substituting the true range for volume here, which is more important to you, a small range with overly large volume, or the larger range part? Because you can't pick up the small range.
They're both important to me. The question is, what's more important, the large range or the small range with volume? They're both important to me. It just depends where it occurs.
So the true range won't work to find to substitute for volume in that case when you don't have a...
No, it won't. When you have a little narrow range with a great deal of volume like we had on the APA chart, and the market was coming down underneath the support line and there was no volume to show you the huge effort and no reward, you would not have picked that up without volume. That's true. I'm not saying that I would want to trade without volume, but with Forex, for example, the only volume that I know of is tick volume. I use tick volume in conjunction with range. So.
The whole thing was, we're talking about the Halls, the Wyckoff, after the result. You know, Gavin, VSA may call it something different. I may call it something different. It's the same principle
exactly the same.
of no demand, lack of buyers. Whatever you want to call this, call it profitability. Call it a retest on light volume. Call it a no demand. It doesn't matter what you call it. Identifying it and profiting from it is the key.
Right.
Right.
Yeah. Do you want
Absolutely.
to repeat that to the audience on the internet? What was said there, because that's important.
Well, what Gary Fullett just said is that what's important is making the money on this situation, and it doesn't really matter what we call it. We might all have different terms, but the thing is not the name. I hate to get into semantics, but it's not the name.
Correct.
It's the behavior. Whatever you want to call it. You can call it Uggams, Waggams, Blick. It doesn't matter.
But what's important is that we all have the same eyes to identify it, whether it's a VSA software, whether it's
Right.
David Weiss, or whether it's Gary Fuller or Gary Day. It doesn't matter. All should be able to see it with the same eyes, and all should be able to benefit from it.
Mm-hmm.
Is the point?
Yeah,
How you do it, we don't care. Just we want to be on the right side.
So Gary Fullett has just reiterated it again for those of you who are on the internet.
Yeah.
Okay, well, I have certainly enjoyed being here today and look forward to tomorrow. I have a lot more to show, introduce that I've never shown before on any speaking venue I've had before.
Wow.
Take care.
Great. Thanks. Big round of applause.